This video provides an institutional briefing on standby letters of credit versus bank guarantees, covering their structure, applicable rules, claim processes, and inherent risks. It is essential to understand that the label of an instrument is not the legal answer. While commercial purposes may overlap, legal characterization, including claim mechanics and defenses, depends entirely on the text of the instrument. Understanding the difference between an independent undertaking and an accessory suretyship is vital. An independent undertaking focuses on complying presentations, whereas an accessory suretyship depends on the underlying contract and primary debtor's performance. The issuance chain involves several key roles, including the applicant, beneficiary, and various banking entities like the issuer, guarantor, advising bank, and confirmer, each with distinct responsibilities. There are many variants of both standby letters of credit and bank guarantees. It is important to align the specific trigger, liability, and documentary conditions with the commercial obligation being secured. Standardized frameworks such as ISP 98, URDG 758, and UCP 600 provide rules for these instruments. Without incorporated rules, the instrument text and governing law must cover all operational requirements. A direct issuance workflow moves from the commercial contract and request to bank review, issuance via SWIFT, and finally, verification by the beneficiary. Risk allocation between the applicant and beneficiary is a critical component. In an indirect issuance, an instructing bank issues a counter undertaking to a local issuing bank. Key risks here include expiry alignment and ensuring demand conditions are compatible across the different layers. SWIFT messaging is used to manage these instruments. However, the message type does not define the economic substance. Always verify the operative terms independently, rather than relying solely on the message type. The documentary claim and examination workflow requires careful preparation of the demand and adherence to stated conditions. Banks examine the documents themselves, not the underlying performance. Managing the life cycle of an instrument involves various clauses such as expiry, evergreen extensions, extender pay options, and rules regarding partial drawings or reductions in liability. Rights regarding transfer, proceeds, and reimbursement are specific and often restricted. Note that these instruments are not freely tradable and are generally not usable as loan collateral by third parties. Selecting the right instrument depends on the specific scenario. This matrix highlights how different requirements, such as cross-border payments or construction obligations, align with particular instruments and rules. When drafting an instrument, use a checklist covering parties, undertaking types, amount and value, demand packages, and operational compliance. Always have final text reviewed by legal counsel. Be aware of fraud red flags. Claims regarding leased instruments, high-yield schemes, or requests to bypass standard bank compliance are significant warnings that require enhanced verification. For next steps in your transaction, our advisory services include transaction mapping, bank-ready presentation support, and coordination of documentation and processes. You can learn more by visiting our website.